Inflation is always a big topic on the investment scene, but when short-term tips were recently issued at negative yields, it became the focus of even more attention, as it suggested that even though inflation is tame now, investors were concerned it might pick up down the road. But while we're certainly adept at tracking inflation, many of us still aren't particularly good at factoring the concept of inflation into our finances, and especially our retirement planning. And in fact, behavioral economists have a name for this phenomenon, money illusion, which essentially means that we don't really appreciate how much inflation can affect our long-term purchasing power. For example, let's take the case of someone retiring today at age 65 who needs $50,000 a year in spending money to maintain an acceptable lifestyle. If inflation moves along even at a relatively modest rate of 2% a year, at age 75 that person would need about $61,000 a year to maintain the same standard of living, and by age 85 that person would require about $74,000 a year. If inflation were to run at 3%, the required amounts would be even higher. In short, even if inflation stays below or around its historical average, it can erode one's buying power by roughly 30% to 45% over just 20 years. So, how can you counteract this tendency to think in nominal rather than inflation-adjusted terms and prevent money illusion from disrupting your retirement plans? Well, when you're in the early stages of retirement planning, in addition to saving on a regular basis, it's important that you invest for long-term growth, which means making stocks or stock mutual funds a core holding in your 401k and other retirement accounts, along with bonds or bond funds. Granted, you may be tempted to shun stocks given their lackluster performance over the past decade and their often scary volatility. But long term, they actually have a better record than other asset classes of providing the highest inflation-adjusted returns. And with yields on bonds and cash so low these days, it's hard to see how these alternatives alone will keep your savings growing faster than inflation. To see how different mixes of stocks and bonds will affect the eventual amount of income you'll be able to draw from your nest egg at retirement, you can go to a tool like the T. Rowe Price Retirement Income Calculator. When you're closer to retiring or actually retired, you want to create a budget that outlines your retirement expenses as accurately as possible and shows how those expenses might grow with inflation. You can make such a budget and factor in inflation by going to the interactive budget worksheet that's part of Fidelity's Retirement Income Planner tool. One way or another, though, you want to be sure you're not falling for money illusion and failing to consider inflation's effect on your planning. Otherwise, you may find that the cozy retirement you envision is nothing but